Welcome to the deep dive. Today, we're looking at something, well, pretty interesting. A major global company, you probably interact with them without even realizing it. They just announced really strong financial results.
Yeah, handily beating Wall Street expectations.
Exactly. And yet, their stock took a noticeable tumble right after the news. It definitely makes you wonder what's really going on under the hood.
Just a classic market paradox, isn't it? Good news, bad reaction.
Right. So our mission today is to unpack Accenture's Q3 fiscal year 2025 performance. We're going to dig into the numbers, look at the big strategic moves they're making, and try to figure out what actually drove that, well, seemingly contradictory market reaction.
And to do that, we've got quite a bit to work with. Accenture's own earnings materials, infographics, detailed reports.
Plus analysis from financial publications, and we even looked back at a previous earnings call transcript just to get some context.
Definitely helps paint the bigger picture.
Okay, so let's get into it. On the surface, Accenture's Q3, the results look genuinely impressive. I mean, total revenues hit $17.7 billion.
Yep, $17.7 billion. That's up 8% in U.S. dollars.
Yeah.
Or 7% in local currency compared to the same time last year.
And crucially, that beat Wall Street's expectation. They were looking for about $17.3 billion, so a solid beat there.
And not just on revenue. Earnings per share, EPS, that was $3.49 for the quarter.
Right.
That's a 15% jump year over year.
Wow, 15%.
Or 12% if you adjust it. But either way, it also beat the analyst estimates. They were expecting around $3.32.
Okay.
And the operating margin looked good too, 16.8%. That's up 80 basis points on a GAAP basis. You know, the standard accounting rules.
Yeah.
Or 40 basis points adjusted.
Right, 80 basis points. That's almost a full percentage point improvement. Shows good efficiency.
Exactly. They generated a ton of cash too. Free cash flow was what, $3.5 billion?
$3.5 billion, yeah. So you look at all that and you think, okay, what's the catch?
Precisely.
Yeah.
On paper, it looks like a home run.
But clearly the market saw something else because the stock fell. What was it? Nearly 6%?
5.88% on June 20th, the day of the announcement. Which leads us to the big question. Why? With numbers like that, why the negative reaction?
What did the market latch onto then?
It seems investors focused really heavily on one thing, a concerning decline in new bookings.
Ah, the forward-looking number.
Exactly. New bookings for Q3 came in at $19.7 billion. Now, that sounds like a lot, but it was significantly below the estimate, which was closer to $21.5 billion.
Okay, so quite a miss on expectations there.
A big miss. And it represents a 6% decrease in U.S. dollars, 7% in local currency, compared to the bookings they got in Q3 last year.
And wasn't this the second quarter in a row for declining bookings?
It was. And this 6% drop was actually worse than the 3% decline they saw the quarter before. So the trend seems to be accelerating a bit there.
And just to remind everyone, new bookings. That's basically future work locked in, right? Future revenue.
Precisely. It's a critical forward-looking indicator. It tells investors how much business the company has secured for the future. So a decline, especially 2 quarters running, makes people nervous about future growth.
Makes sense. Did they say why bookings were down?
Yeah, they attributed it to, well, broader economic uncertainty. Makes sense. And also cutbacks in U.S. government spending.
Ah.
One source we looked at specifically mentioned that the current administration has slowed down some new contracts and cut some existing ones to reduce federal spending.
Right.
Now, that source linked this directly to the stock's recent performance, noting it lost about 13% this year and was down over 20% from its peak. But it's important to add, Accenture itself stated that these specific government spending changes haven't had a, quote, material impact on their operations or financials.
Okay, so a bit of conflicting perspective there.
A little. But the takeaway is clear.
Okay.
For many investors, that future pipeline, those bookings, can sometimes overshadow even really excellent current results. The future view trumped the present in this case.
Right, future growth versus current profit, a classic tension. So, okay, the market's worried about bookings. What's Accenture doing about it? Are they just writing it out?
Oh, definitely not. They're making a pretty big move, actually, a significant organizational restructuring.
Okay.
And it's aimed squarely at capitalizing on, you guessed it, artificial intelligence. AI.
AI, of course. Everyone's favorite topic.
Absolutely. So, effective September 1st, they're combining a bunch of their big service lines, strategy, consulting, song, technology, operations, into one single new unit.
One big unit. What are they calling it?
Reinvention service.
Reinvention services, okay.
And it'll be led by Manish Sharma. The stated goal is pretty clear. compete better in this rapidly growing AI consulting space.
And they're already seeing some traction there, aren't they? The Gen AI bookings.
They are. In Q3 alone, they booked about $1.5 billion specifically in new generative AI work.
So $1.5 billion just in Gen AI,
Yeah.
that's pretty substantial already.
It is, and it leads to the question, how does Accenture see AI? Is it just another service or something more fundamental?
Good question.
Well, looking back at some context from their call last year, they were already emphasizing this point. Clients are experimenting with Gen AI, sure, but the tech itself, that's only a small part of the puzzle.
Right, it's not just about plugging in the AI.
Exactly. They see Gen AI more as a catalyst, a trigger for companies to get much more aggressive about finding cost savings, yes, but also about building a really strong digital core.
Digital core meaning cloud, modern systems, security, that kind of stuff.
Precisely. Migrating to the cloud, putting in modern ERP systems, beefing up security, and also fundamentally changing how people work. Reskilling staff, focusing on responsible AI.
So AI forces all these other changes.
That's their argument. And they position themselves as uniquely able to help with that entire transformation because they have the scale and the expertise across all those different areas: technology, industry knowledge, change management, everything.
They're selling the whole package, not just the AI tool.
That's the idea, the whole reinvention.
Okay, interesting strategy. So even with the bookings dip, revenue is still up. Where was that growth actually coming from? Let's break down the segments.
Yeah, looking at the industry groups for Q3, financial services was a real standout. $3.3 billion in revenue, and that was up 13% in local currency.
13%, that's strong, especially for financial services.
Very strong. It shows their strength in a sector that's always pushing digital transformation. Health and public service also did well, $3.8 billion, up 7%.
Okay.
Products was actually their biggest segment by revenue, $5.3 billion, also up 7%. Communications, media technology, that was $2.9 billion, up 5%. And resources, $2.4 billion, up 4%. So growth across the board, but financial services really leading the charge.
And geographically, where's the growth happening?
The Americas were the leader there.
Yeah.
$9 billion in revenue for Q3, and that was 9% local currency growth.
America's leading. Okay.
EMEA, Europe, Middle East, Africa, that was $6.2 billion, up 4%. And Asia Pacific, $2.5 billion, also up 4%.
And didn't they change how they define those regions recently?
They did. Just a quick note on that. Earlier this fiscal year, Latin America moved from what they used to call growth markets into North America, forming the Americas. And the remaining growth markets just became Asia Pacific. Just a classification change to be aware of.
Got it. And what about the type of work? Consulting versus managed services?
Yeah, this is interesting too. Consulting revenue was $9.0 billion, up 6% in local currency.
Which is good,
Yeah.
because consulting had faced some headwinds before.
Yeah, it had. So seeing 6% growth there is a positive sign. And it was nicely balanced by managed services, think outsourcing and ongoing support, which brought in $8.7 billion and grew even faster at 9%.
So both sides of the business growing well helps smooth things out.
Definitely. It shows they can land the big strategic projects and handle the long-term operational work.
And within that, what about their big strategic priorities? Cloud, security.
Those continue to perform very well. Both cloud and security saw strong double-digit growth again in local currency. Security especially seems to be a consistent high flyer for them.
No surprise there, given the environment.
Not at all. Industry X, that's their digital manufacturing and engineering arm, saw high single-digit growth. And Song, the customer experience unit, had mid-single-digit growth.
So it really is a broad base of growth drivers supporting that overall number.
It is. It underlines that holistic approach they keep talking about.
Okay, let's talk cash. You mentioned strong free cash flow earlier, $3.5 billion in Q3.
Yep. And for the first 9 months of their fiscal year, so year to date, it was $7.1 billion. That's a lot of cash generation.
And what are they doing with all that cash? Returning it to shareholders.
They are. They paid out a quarterly dividend of $1.48 per share back in May. That totaled about $924 million.
And wasn't that dividend up significantly from last year?
It was a 15% increase over the rate in fiscal 2024. Pretty substantial hike.
Right.
And they've already declared the next one at the same $1.48 rate, payable in August.
Okay, so dividends are strong. What about share buybacks?
Also very active there. In Q3 alone, they bought back 6 million shares for $1.8 billion.
$1.8 billion in just one quarter.
Yeah. And as of the end of May, they still had authorization to repurchase another $3.3 billion worth of shares. So they're clearly committed to returning capital.
And what does their overall cash balance look like?
It's healthy. End of May, they had $9.6 billion in cash on the balance sheet. That's way up from the $5.2 billion they had at the end of the last fiscal year.
So, a very strong cash position. What about debt? Sometimes companies load up on debt to fund buybacks.
That's a fair point, but in Accenture's case, their debt levels are actually considered quite low for a company their size. Based on previous discussions we've seen, while it might fluctuate slightly, it's generally managed as part of their normal treasury operations, maybe using a credit facility.
So, not a major concern.
Not really. Having that strong balance sheet, lots of cash, and relatively low debt, it gives them huge flexibility. They can invest heavily in AI, make acquisitions, keep buying back shares. Even if the economy gets shaky, it's a strategic plus.
Right, it fuels that reinvention engine. Okay, so let's look ahead. The outlook. Despite the market's reaction to bookings, Accenture actually raised their forecast for the full fiscal year, didn't they?
They did, which is another layer to this whole story. As of June 20th, they updated their FY25 outlook. Revenue growth, they now expect 6% to 7% in local currency.
It's up from...
Up from the 5% to 7% range they gave back in March. So they tightened the range and raised the bottom end.
Okay, positive signal there.
And diluted EPS, they raised that forecast too. Now expecting $12.77 to $12.89. Previously, it was $12.55 to $12.79.
Oh, wow, to bump up.
And cash flow. Free cash flow forecast also increased. Now $9.0 billion to $9.7 billion, up from $8.8 billion to $9.5 billion previously.
So they're more optimistic about the full year finishing strong, despite the Q3 bookings dip.
Seems that way. And for Q4 specifically, the final quarter, they're projecting revenues between $17.0 billion and $17.6 billion.
Okay, so to recap the market sentiment, they beat Q3 estimates, they raised the full year outlook, but the stock still dropped because the market focused laser-like on that Q3 bookings decline.
That sums it up pretty well. Wall Street analysts, on average, still seem pretty positive. The average price target is around $353.80, suggesting upside from where it fell. But they acknowledge the split, right? Strong current performance, improving outlook, versus those weaker forward-looking bookings. That divergence is likely going to mean continued volatility for the stock. It's that classic Wall Street tug-of-war.
The present versus the future. So let's dig into that strategy again, this reinvention idea. How does having such broad capabilities actually help them pull this off, especially when, companies might be cutting back on big projects?
That's really the core of their value proposition, isn't it? Their strength is that breadth. Having deep expertise not just in tech, but in strategy, specific industries, operations, creative, the whole nine yards.
Like Industry X and Song.
Exactly. It means they can tackle those really complex, messy transformations that require way more than just installing some software. They can handle the people side, the process changes, the industry specifics.
And we saw some examples of this from the source materials, right? Illustrating this holistic approach.
Yeah, definitely. Like their work with Currys, the European retailer, it wasn't just let's move to the cloud. It was about rethinking the whole business.
Right, moving off legacy systems, building that digital core you mentioned, then layering in automation and Gen AI for things like customer service.
Exactly, a total overhaul. Or look at Independence Health Group in the U.S., migrating millions of members to a new digital platform, preparing for AI, and retraining their staff along the way.
That reskilling piece is huge.
Crucial. And think about the Central Bank of the UAE using advanced analytics, AI automation for complex things like regulatory compliance. That's not simple stuff.
No, definitely not. These are deep, complex projects.
They are. And they span different needs. Look at Virgin Media O2, using Accenture's platform for 5G edge computing services. That involves edge tech, data, AI, security. All integrated. Or the U.S. Navy, enhancing cybersecurity. These are big mission-critical transformations.
And we saw some specific Gen AI use cases too, not just the broad strategy, like that food and beverage company.
Right, the digital shelf console pilot. Using Gen AI to speed up creating and optimizing e-commerce content, they expected to cut delivery time and save potentially up to 80% in costs.
80%. That's a tangible ROI.
That gets attention. And it's not just about cost. Think about National Australia Bank. Accenture's helping them scale Gen AI securely, building a platform, identifying hundreds of potential use cases, and focusing heavily on responsible AI principles from the start.
So implementation and governance.
Exactly. And look at Song, their experience agency. It's not just creative. It blends that with customer insights and deep tech. They mentioned using their Gen Wizard tool with Saudi Airlines for a new Gen AI-powered digital platform. Again, transforming the customer experience, not just tweaking a process.
Or Industry X, helping an automaker move towards software-defined vehicles, accelerating their software development.
Yeah, building a whole software center of excellence. It really shows how they apply these capabilities across very different industries and very different types of challenges.
Okay, so wrapping this up, this deep dive into Accenture's Q3, it really shows a company performing well operationally right now, especially with momentum in AI and those related transformation services.
Definitely strong current performance. But, as we saw, the market reaction zeroed in on those forward-looking bookings. That was the key takeaway for investors on the day.
Right, and Accenture's response isn't to panic, but to double down on this reinvention strategy, restructuring, pushing AI as the catalyst for much bigger client transformations. They're positioning for the long haul, it seems.
Absolutely. They see AI not just as a tool, but as the trigger for the next wave of large-scale change, and they believe they're uniquely positioned to guide clients through it.
It certainly highlights how, in today's market, especially with tech, the narrative about the future can sometimes carry more weight than the immediate numbers.
It really does. And that leads to a final thought, something for you, the listener, to consider. This whole situation really underscores that disconnect, doesn't it, between current results and future signals. So when you're evaluating any business, what forward-looking indicators do you prioritize? And how much weight do you give a company's big strategic pivots, like Accenture's push into reinvention, especially when the market seems focused elsewhere?